Let's start at the very beginning, with a simple question. What exactly is a stock and why do people care so much about them? Maybe you've heard about stocks on the news or from friends talking about the latest hot company. But what does it really mean to own a stock? Picture your favorite company as a giant delicious pizza, one that's way too big for any single person to eat alone. This pizza represents the entire company, with all its assets, ideas and profits. Now imagine that pizza is sliced into thousands or even millions of tiny pieces. Each slice is a stock. When you buy a stock, you're actually buying a small piece of that company's pizza. Owning a stock means you own a real, albeit tiny, part of the company. You get to share in its success. And sometimes, its struggles. If the company does well, maybe it sells more products, invents something new, or just becomes more popular, your slice of pizza could become more valuable. That means your stock could be worth more than what you paid for it. But you're not stuck with your slice forever. You can trade it. Buying and selling stocks is like swapping pizza slices with other people who want a taste of that company. All this buying and selling happens in a place called the stock market. Think of it as a giant, bustling digital marketplace where people from all over the world come to trade their company slices. The stock market is open for business on most weekdays, and prices can change every second as people decide what they think each slice is worth. To join in, you use a broker, usually an online platform or app. With just a few taps, you can buy or sell stocks from your phone or computer, no matter where you are. The price you pay for a stock isn't random. It's set by supply and demand, just like tickets to a sold-out concert. If lots of people want a slice, the price goes up. If fewer people are interested, the price drops. The main goal for most people? Buy low, sell high. In other words, get your slice when it's cheap and sell it when it's worth more. Of course, it sounds simple, but in reality, stock prices move up and down for countless reasons. News, rumors, world events, or even just people's feelings about the future. Sometimes a single news story can send prices soaring or tumbling in minutes. That's why the stock market can feel unpredictable, even a little wild at times. The trick isn't to guess randomly, but to make educated decisions. Smart investors study companies, look at trends, and try to predict what might happen next. This isn't a casino. Successful trading means doing your homework, reading reports, understanding the business, and knowing what you're getting into. Before you invest, take time to understand the companies you're interested in. What do they do? How do they make money? What challenges do they face? And always have a plan. Decide ahead of time what you'll do if things go well, or if they don't. Investing is about managing both wins and losses. Remember, trading stocks is a way to try to grow your money, but it's not without risks. Prices can fall as easily as they rise, and there are no guarantees. Unlike simply saving money in a bank, investing in stocks is more active. It takes attention, learning, and sometimes a bit of courage to ride out the ups and downs. Over time, with patience and smart choices, investing in stocks can help your money grow faster than just letting it sit. But it's a journey, not a sprint. Now that you know what a stock is, let's dive deeper into how to pick the right ones for you. Imagine you're at the store choosing apples. You'd pick the healthy, shiny ones, not the bruised, soft ones. Stocks are similar. Some companies are strong and growing, others are struggling. Picking the right stock matters because your money is at stake. Invest in strong companies and your shares are more likely to grow in value. Weak companies can lose you money. It's not luck. It's about making informed choices. Think of yourself as a business partner. Would you join a failing business? Research is key. Inspect the company like you'd inspect fruit. Your goals matter too. Some stocks are slow and steady, others are fast but risky. Choose what fits your needs and risk tolerance. Stock research doesn't have to be scary. Start with companies you know and use. Next, understand how the company makes money. Can you explain it simply? Check the company's financial health. Is revenue and profit growing year after year? Use free sites like Yahoo Finance to find this info. Look for steady, consistent growth. Consider the company's future. Are they innovating or expanding? Is their industry growing or shrinking? Invest in companies with a bright outlook, not those in decline. These steps help you spot promising stocks. Do your homework before you buy. Think of a company's performance like a doctor checks vital signs. The two key numbers, revenue, total sales, and earnings, profit after expenses. Companies report these every 3 months. You want to see both numbers rising over time. Pay attention to the company's future guidance. What do leaders expect next? News matters, new products, partnerships, or problems can move stock prices fast. Set up news alerts to stay informed. Check what analysts are saying, but don't rely only on their opinions. Combine numbers, company news, and your own research. This gives you a clear picture of whether a stock is a good choice. Stay informed and make decisions based on facts. Let's talk about risk. When you start trading, it's easy to focus on the excitement of making money, but it's just as important to understand the risks involved. Every investment comes with the possibility of loss, and being aware of that is the first step to becoming a smart trader. Stocks can go down as easily as they go up. The market is unpredictable, prices can swing wildly in a single day, and even the most promising companies can face setbacks. It's important to remember that past performance doesn't guarantee future results. Losses are part of trading. Even the best traders lose sometimes. No one wins all the time, and accepting losses as part of the process helps you stay calm and focused. Learning from your mistakes is just as valuable as celebrating your wins. Don't put all your money in one stock. That's risky. If that company struggles, your entire investment could take a big hit. Concentrating your money in one place is like walking a tightrope without a safety net. Diversify. Spread your money across different companies and industries. This way, if one investment goes down, others might go up or stay steady, balancing out your risk. Diversification is a key strategy for long-term success. Emotional decisions are dangerous. Don't let fear or greed control you. Emotional reactions can lead to impulsive decisions like panic selling during a dip or chasing after a stock that's already soared. Staying calm and rational is crucial. Stick to your plan, not your gut. Create a strategy before you invest, and follow it even when the market gets turbulent. Having clear rules helps you avoid costly mistakes and keeps your emotions in check. Beware of hot tips and guaranteed schemes. They're usually scams. If someone promises you easy money or a sure thing, be skeptical. Scammers prey on people's hopes and fears, so always question offers that sound too good to be true. There's no sure thing in trading. Markets are influenced by countless factors: news, politics, global events, and even rumors. No one can predict the future with certainty, so be prepared for surprises. Always do your own research. Take time to understand what you're investing in, read company reports, and learn about the industries you're interested in. The more informed you are, the better your decisions will be. If something sounds too good to be true, it probably is. High returns with no risk don't exist in the real world. Trust your instincts and walk away from anything that feels suspicious. Protect your money by respecting the risks. Set limits on how much you're willing to lose and never invest money you can't afford to part with. Being cautious is a sign of strength, not weakness. Manage your losses so no single trade wipes you out. Use tools like stop-loss orders to limit potential damage and review your trades regularly to learn and improve. Diversification and discipline are your best defenses. Stay skeptical and informed. Remember, trading is a marathon, not a sprint. Patience and consistency will serve you well over time. That's how you protect your hard-earned money. By understanding the risks, making thoughtful decisions, and staying disciplined, you give yourself the best chance to succeed in the world of trading. In trading, a trend is your friend. An uptrend means prices are rising. A downtrend means they're falling. Spot trends by looking at stock charts. Patterns emerge over time. Use moving averages to smooth out price swings and see the trend. If the price stays above its moving average, it's likely in an uptrend. Buy during pullbacks in an uptrend for better prices. Watch for signs a trend is ending, like failing to reach new highs. High trading volume during a price drop can signal trouble. Learning to spot trends takes practice, but it's key for timing trades. Ride the trend, but know when to get off. Many beginners trade without a plan. That's like starting a road trip with no map. Always know your exit points, when to take profit and when to cut losses. Overtrading is another trap. More trades mean more fees and more mistakes. Be patient. Quality trades beat quantity. Don't try to time the exact top or bottom. No one can. Aim to catch a good part of a trend, not every penny. Don't be greedy. Refusing to admit mistakes is costly. Cut losses quickly if a trade goes wrong. Protect your capital above all else. Learn from every trade, good or bad. Keep emotions out of your decisions. Discipline and self-reflection are key. Avoid these pitfalls to stay in the game. A trading plan is your rulebook. It can be just one page. First, define what stocks you'll trade, set clear criteria. Next, set entry and exit rules. When to buy, when to take profit, and when to cut losses. Use a stop loss to limit risk, stick to it. Decide how much to risk per trade. The 2% rule is a good start. Never risk more than 2% of your account on one trade. This keeps you in the game, even after a few losses. Keep a trading journal. Write down your reasons and results for every trade. Review your journal to learn and improve. Self-evaluation separates successful traders from gamblers. Your plan is your blueprint for success. You've learned the basics of stock trading, and that's a huge achievement. Every expert was once a beginner, and you've already taken the first important steps. You now have a solid understanding of what stocks are, how they work, and why they matter in the world of finance. This knowledge is your passport to a much bigger world of opportunities. You know what a stock is, why research matters, and how to manage risk. You've learned that every trade should be backed by careful research, and that protecting your money is just as important as making it grow. These are the habits that set successful traders apart from the rest. You understand trends, common mistakes, and how to build a trading plan. You've seen how markets move in cycles, and you know that having a plan helps you stay focused, even when things get unpredictable. Mistakes are part of the process, but now you know how to spot them and learn from them. This is your foundation. Be proud you've started the right way. Many people jump in without preparation, but you've chosen to build your skills first. That's something to celebrate. Remember, trading is a marathon, not a sprint. It's about steady progress, not quick wins. The journey will test your patience and discipline, but those who stick with it are the ones who succeed in the long run. Start small, even with a practice account. There's no rush to risk real money. Use this time to experiment, make mistakes, and learn without pressure. Every bit of practice builds your confidence and sharpens your skills. Focus on learning and protecting your capital. Think of your money as a tool, not just a scorecard. The best traders are always careful, always thinking about how to minimize losses and maximize learning. There will be ups and downs. Learn from every experience. The market can be unpredictable, but every high and low is a lesson. Keep a journal, reflect on your trades, and use every outcome to improve. Stay curious and keep learning. The market is always changing. New trends, new technologies, and new opportunities appear all the time. The more you learn, the better prepared you'll be to spot them. Read, follow news, and learn from others. Join communities, ask questions, and share your experiences. The trading world is full of people who started just like you, and their stories can help guide your own path. The journey is about discipline and growth. It's not just about making money. It's about becoming a better, more thoughtful trader every day. Take time to reflect, stay calm, and keep your goals in mind. You've taken the first step, keep going. Every day you show up, you're building momentum. Don't let setbacks stop you. Use them as fuel to keep moving forward. With a plan and respect for risk, you're ready to begin. You have the tools, the mindset, and the determination to make your mark. Trust your preparation and stay committed to your process. Go forward with confidence and start your journey. The world of trading is waiting for you. Step into it with curiosity, courage, and the knowledge you've worked so hard to build.